Hello, Andrew here, welcome to my channel on investing. Rivian is one of the few newly minted EV car makers that are still standing today. Many others such as Lucid, Fisker or Faraday Future went bankrupt or are on the brink of going bankrupt. Rivian stock took a wild ride, surging to $180 and then plunging to something like $10 a share today. So it seems like a good bargain, right? Well, in my opinion, there are many reasons to stay away from Rivian stock. Here's why. First, the cash burn at Rivian has been accelerating at an alarming pace. If we look at free cash flows, the company has been net negative. Looking at Rivian's cash balance, we see that it stands at $9.4 billion. The company can borrow additional $1.1 billion under its term loan facility. So the total liquidity is at $10.5 billion. But it doesn't take much to see that this is enough only for 2 years if the rate of existing cash burn continues. And to be fair, Rivian recently announced a delay in Georgia plant construction. Such step will save it about $2.3 billion, but it's only delayed. Rivian will still incur these $2.3 billion in the future, and it may not have capital for that. Thus, the capital raises either through convertible debt or equity are inevitable. But given the low stock price today, the equity issuance is unattractive, so probably convertible debt, which will lead to more stock dilution. And we don't know really where the financial markets will be in the next several years. If for any reason Rivian fails to make an equity or convertible debt issuance and raise a capital, it may have to face tough choices. I don't think it will go bankrupt, but the buyout is likely at a lower price. Rivian remains gross profit margin negative. As its production scaled from 0 to 50,000 deliveries, the gross margin improved, but it surprisingly stayed negative. That is a worrying sign. If we compare Rivian of today to Tesla of 2015, here's what we see. Tesla also delivered 50,000 cars and generated positive 20% plus gross profit margin. Tesla even had higher positive gross margins at lower delivery levels. Something is not going right for Rivian on its factory floors. Rivian lost roughly $40,500 on each vehicle it sold in 2023. It is possible that Rivian will get to positive gross margin, but it's not clear when and at what production volume. More recently, Rivian made an announcement that they will get to break-even gross margin by Q4 of 2024. Let's take a closer look at that. Here's the chart from the company's recent shareholders update. The first thing to notice is that this is a quarterly projection. In other words, Rivian is comparing Q4 quarters across different years. Nowhere has it mentioned numbers in Q1 through Q3. Rivian may get positive gross margin in Q4, but what if its Q1 through Q3 numbers are overwhelmingly negative? Their path to positive gross margin hinges on material cost reductions, engineering changes, optimizations, and non-vehicle revenue. But there are a lot of things that can go wrong here. Cost reductions in car manufacturing can come from two major sources, which are scale or better tech. Rivian is guiding a production of 57,000 cars in 2024, so it's roughly the same production as it was in 2023. I do not understand how Rivian will be able to get from negative 46% gross margin in last year to 0% just based on tech alone. It's very unlikely in my opinion. It's a very optimistic forecast. It will be like a miracle if they do get to positive margin in Q4. Also, there is a 15% margin improvement from non-vehicle revenue sources such as finance, insurance, and software. But it is strange that they say revenues. Even these non-vehicle services have their own costs. Rivian is starting to offer these services pretty much from scratch. High cost and losses at the beginning are very likely. So in my opinion, this roadmap is definitely a possibility, but it's very difficult for me to imagine how they will be able to get there. The other problem with Rivian is that it doesn't have inexpensive cars. Most of its vehicles are expensive and target rich consumers. The starting point for vehicles by Rivian are $70,000 and go up from there. And generally just there are fewer wealthy customers in the US. Moreover, Tesla and others were saturating this customer segment with their own luxury offerings for years. And this can partly explain why the demand in the US is slowing down. In 2023 it was 45% the growth rate, but in 2024 it is expected to be 30% or so. It's still positive in large number, but it is falling. And Rivian was struggling with astronomically high growth numbers. But what it's gonna do when these growth rates are going to plummet or slow down? Recognizing how expensive cars weigh on its sales, Rivian introduced a standard battery pack for its existing models. This battery pack is expected to have lower range and cost about $9,000 less. But here's the problem with this pack. The pack is not much smaller actually in terms of materials. So in my opinion, there is not much margin to gain here. Rivian simply traded the reductions of material cost for a lower price. In 2024, Rivian unveiled R2, which is an SUV at $45,000 price tag, with a starting production date of first half of 2026. RJ Scaringe also promised even a cheaper SUV called R3. He didn't disclose the release date and its pricing. These moves are positive and in the right direction. But I personally have many reservations about it. Showing a prototype is one thing, but producing it at scale and profit is a completely different matter. Rivian was struggling with its own existing R1 lineup and turned a profit on it. So I don't think it's gonna be any easier with the cheaper models at lower price points. Many things will have to go right for Rivian to succeed. Moreover, competition is likely to be very different by 2026 or beyond. Tesla is planning to release soon its highly anticipated $25,000 price tag crossover model, which could be a big shock for Rivian. Tesla overall is firing in all cylinders with reducing cost, scaling, and vertical integration. They're producing their own batteries, and soon they will be refining even their own lithium within the next several years. Conversely, Rivian relies on others to get its batteries, and this puts it at a disadvantage to Tesla. So yeah, I don't know, maybe R2 and R3 may not be enough to save the ship. The higher competition and lower prices may undercut Rivian, and I think future price cuts are inevitable. Will Rivian have enough profit margin to absorb these lower prices? I have a lot of doubt about that. On top of that, there is no Chinese competition in the US market. Well, at least for now. BYD, a Chinese company that I profiled in my previous video, is planning to open a factory in Mexico. BYD is a vertically integrated company, produces its own batteries, and it has cars that are inexpensive and competitive. For now, they said that they are not planning to enter the US market. This is a smart response to avoid backlash. First, BYD will work on its supply chain to satisfy the USMCA trade agreement requirements. And after that, I don't see any reason why they wouldn't enter the US market. I mean, at least it's years from today, but it's still a possibility and a future threat to Rivian and many other US car makers. So based on my assessment, I'm struggling to come up with reasons to invest in Rivian stock. What do you think? Let me know in the comment section. I'm curious to hear your opinion. That's it for today, guys. Please share this video and give it a like if you learned something new today. Also, subscribe to my channel for more content on investing. Thank you for watching.